Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with your portfolio construction and asset allocation. Now, a few weeks ago, we took a look at the market consensus on asset allocation, and one of which was a general view that Chinese equities will continue to underperform. We argued at the time that a positive surprise for Chinese equities could come from a policy catalyst given reasonable valuations and also light positioning by investors. Now, this could be more aggressive macro stimulus from Beijing or tapered hostility from the new Trump administration. Now, this positive surprise did come, but we were only half right on the why. As we're about 1/6 of the way through 2025, MSCI China is up 13.5% since the start of the year, outperforming S&P 500 and also the Nasdaq index. Only European equities posted comparable performance. This is another story that we'll come back to in another episode. Now, we've seen short bursts of strong Chinese market performance in the past few years, and they were often ended with disappointment. The phrase, "this time is different," is often cursed in investing, but it is worth understanding the dynamics behind this current rally and examine whether this could be sustainable. We do think there's some room for optimism. Now, we see there are three broad reasons for the recent market rally. Number one, President Trump's tariff against China were not as aggressive as first feared, at least for the time being. He imposed a 10% tariff on all Chinese exports and China retaliated. But this was a lot smaller than the 60% that he pledged during his campaign. Moreover, other economies are also being hit with tariffs or threatened with tariffs, so the individual pain on the Chinese economy seems to be more manageable. Also, there are signs that Washington will be looking to negotiate with Beijing in order to avoid the worst of tariffs. All this helps investors to move away from the worst case scenario, even though we must warn that more tariffs or other export restrictions can't be ruled out from the current administration. Second, some of the more recent economic data from China is not so bad. The January total social financing data came in stronger than expected, with some pickup in lending data. Medium to long-term loan data to the household sector increased the most in 12 months, indicating some pickup in home sales. Over the Lunar New Year holidays, per capita spending is still lower than pre-2021, but passenger traffic and aggregate spending data continue to grow. This shows that the Chinese economy had a decent start in 2025. But the third reason is arguably the most important. The release of the Deepseek artificial intelligence model in January is an important milestone that Chinese AI development is making progress and not significantly behind the US despite export restrictions of AI technology and also cutting-edge GPUs. This also triggered market expectations of potential users of AI teaming up with AI developers to monetize this technology and also boosting earnings and profit margin. This resulted in a valuation re-rating of Chinese tech companies and potential beneficiaries. Admittedly, this is still too early to map a definitive path on how this monetization could become reality in the short term. However, leading Chinese tech giants have historically been successful in integrating social media platforms with e-commerce and other consumer and business services. They could be in the prime position to benefit from AI and expand on their revenue and profit margin. On February 17th, President Xi met with a number of Chinese tech leaders. Overall, the tone of the meeting suggests the importance of these tech firms' role in keeping China's technological developments competitive vis-a-vis the US, and also the government support behind them. This could be a positive signal for company valuations after a series of antitrust investigation on tech giants back in 2020 that has led to a significant valuation derating of these companies. Overall, we were looking for fiscal and monetary support for the economy to improve our earnings outlook. While this could still happen after the National People's Congress meetings in early March, the return of the AI and tech theme could be equally interesting, if not more so. At a high level, this could be the start of another earnings structural growth cycle if AI technology is applied to various sectors. This could also potentially kickstart another round of investment and hiring by the private sector, which could help to provide more momentum to the economy. Of course, this could also mean government support to the economy could come in weaker than expected, but I do see a private investment-driven cycle to be more sustainable and self-reinforcing instead of just relying on fiscal support. Overall, this tech performance is being reflected in the Hong Kong H-share markets for now, since both Chinese and international investors can easily invest in Hong Kong, and also there is a high representation of some of these tech giants in Hong Kong. However, as the AI theme continues to cascade to the broader economy, we could see some selected A-share benefiting as well. This rotation away from high dividend stocks to tech would require active stock picking. So thank you for listening and tuning in. I hope you found this useful. If you have any additional questions for investing, feel free to reach out to your JP Morgan Asset Management client advisors. Please subscribe and share with your friends and colleagues if you find this podcast helpful. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.